With our top story, investors adjusting to a much slower Chinese economy.
The growth model in China is basically done.
China's been slowing
down quite a bit.
But naturally, it has to slow down.
The number one driver that can change the narrative here is a materialization of China's stimulus in the real data.
We don't think China's going to ease off on stimulus.
A government that is very keen on stabilizing the economy.
Using all the tools to get more rapid growth in the future.
Pushing stimulus pretty hard.
They are easing monetary policies, they are injecting liquidity.
The stimulus came in the fall. Usually the impact of it manifests itself 6 to 9 months. That means today.
I think they can hold on for a little bit.
It can buy growth for now.
Joining me around the table to discuss is Robert Tipp, PGIM Fixed Income CIO, and Michael Shaoul, Marketfield Asset Management founding partner and CEO, and Gershon Distenfeld, AllianceBernstein co-head of Fixed Income. Let's begin with you, Gershon. Interesting that we keep getting this weak data out of China and the market continues to look through it. Why?
Well, we're finally, after we've been talking about it for 10 years, and now it's actually happening. And, you know, usually markets do react when things happen. In this case, it's been so well anticipated that, and the markets seem to be in the complete reverse of what it was in the fourth quarter. The fourth quarter, anything that happened was bad.
Yep.
Anything in the world was bad. You know, even good news was an excuse for markets to sell off because it meant the Fed was going to be more aggressive. And now it seems like the market's just shrugging off everything. And I think, you know, slowing growth in China is the latest thing.
Robert?
It's been very gradual, and it's been adjusted not only in China, but really around the world. I think there's a growing anxiety, though. I mean, when you look at Japan, when you look at Europe, the growth outcomes have continued to slow. And those are places where, in Japan, they thought they had the momentum to raise taxes. They, not that long ago, were talking about normalization, widening the band on JGBs, ECB reducing their purchases, looking forward to raising rates this year. Now there's a growing sense of unease. What are they going to do? Are they going to need to ease again? Because the growth numbers are looking that bad. So it is coming through the system.
Many ways of looking at the slowdown in China over the last few months, Michael, over the last year for that matter. The data we had this morning, I guess a knee-jerk reaction could be, well, unemployment's ticked up quite aggressively, so that means more stimulus is coming. The other way you could look at this is actually they've been pumping stimulus into the economy for the last 9 months. There's no real sign it's started to bite in a material way. How do you frame it?
Well, first thing I'd say is that Chinese unemployment data has only been around for a couple of years. It is volatile. We really don't know what the move actually means in historic terms, and you know there's not enough deterioration in the overall data to suggest that there's been a meaningful change in underlying employment in China. So it's a bad print. It's not necessarily telling you anything that much. You know, I think when I look at China's data, parts of the economy are holding up fairly well. Parts are quite weak. They have one massive problem in automobiles. It stands out in terms of what's actually being bought and what's actually being produced. And in fact, the industrial output number, you've actually had negative growth in automobiles. If you took that out, industrial production wouldn't look that different. I don't think you can simply ignore automobiles. It's a big part of that economy. Yeah. It is the world's largest automobile market, so you can't say it's nothing. But there are portions of the industrial complex in China which are stronger today than they've been for 6, 7 years. Ironically, the stuff that got really weak, 2011, 2014, really had to be restructured. A lot of the commodity-related sectors look better today than they have in 5, 6 years. So it's not a straightforward pre-recession or slowdown in China.
Gershon, you agree with this?
Absolutely. I mean, we've been saying for a long time, there's not one credit cycle. We've been through a cycle in the commodity space. A lot of the companies that couldn't survive at $50 oil, let's say, have restructured. But I mean, Michael brings up an excellent point on the newness of the unemployment data in China. We don't even really understand what's going on in the U.S., which is, you know, we've never seen kind of a full employment levels that did not lead to inflation. And yet the markets are saying that the Fed is more likely to cut next, whatever that is, than raise rates. So before we even talk about China and how to interpret the data there, we don't even know how to interpret the data that we've had for 100 years in the U.S.